The challenge is if you came in at that low point and you were just buying calls, you could look brilliant,
Yeah.
right? But don't confuse brilliance with a bull market.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Today's episode is produced in partnership with FinClub.ai. Trade with confidence and take the guesswork out of trading with FinClub's artificial intelligence platform. Now you can get access to the best AI trading platform on the market for as little as $19 per month. That's almost the price of Netflix. So head on over to FinClub.ai to start your 2-week free trial right now. Remember, that's at FinClub.ai. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week.
Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today we have a special guest online, Rance Mayshek. Now, Rance is the founder and creator at MarketGear.com. He's got a pretty interesting platform that he's built there, and we're going to be talking about that and then some of the other things that he's seeing going on in the marketplace. Rance, thank you so much for coming on the show today.
Glad to be here. Really am.
Yeah, I am. I'm excited to have you. You've got a very extensive background and certainly an expert in the field. And I'm really excited to have you on it and share some of the wisdom and expertise in your new platform that we're talking about here today with the audience. So, if you don't mind, could you give maybe a little introduction about yourself and who you are and how we got together today?
Sure, absolutely. So I've been in the space since the mid 90s and worked with educators back then, and then ended up building a platform that we ended up selling to TD Ameritrade and was actually a part of them for several years. I became director of options trading at TD Ameritrade. And then what I found was that there were some things that brokerages weren't really doing a great job, in my viewpoint, of providing to customers. The data's there, but how to really absorb it effectively and all that. So what we did was, after I left them, I started building the platform we're talking about a little bit today, really to visually be able to digest a lot of information, but do it very, very quickly. And this age of Twitterverse, right, where everything has to be so quick and succinct and all that. Yet for a company, there's a lot of data, there's a lot of information. And so what we did was we created something that would be able to help people digest that fast, make a decision, be able to move on, be able to do things, especially around options. We focus a lot on that to make options easy to understand. Options can be very complex, very powerful instrument, but at the same time, there's some complexity there. We've done some things to distill it down and make it a lot easier to work with. And I think that those are things that we're missing from some of the brokerages. And then one of the other things that, I think that the importance of knowing what you're doing in your trading, knowing what the results are, and like journaling what's happening and tracking through so that you learn as you're trading, continue to always improve. That's what we're really focused on with what we're doing at Market Gear and driving kind of better technology for individual investors to be able to take on the markets in today's environment.
Okay. Well, that's really cool. So we talk a lot about options on this podcast, so you're in the right spot. So are you guys talking about buying and selling or both or just one or what do you mostly do?
I'll tell you that mostly it's multi-leg trading. So spread trades, whether it's time spreads, verticals, it depends on what's going on in the market, even on volatile times, things like straddle strangles coming into earnings, things like that. So it's a wide variety of things and around it. What I would say is not so much in just directional options buying, just buying calls or buying puts. We're more really looking at how to create a multi-leg position based on what your outlook is and what your outcome is with a stock. And that I think is one of the most important things about options trading is look at it as you're using an options instrument to trade a stock, but you still have to have an opinion of the stock, right? So that might be stagnant to mildly bullish. Well, in options, you can make money on stagnation, right? You can make money as it's standing still, and then you can skew it to be, stagnant or a little bit bullish, right? So like a diagonalized time spread or something like that. So what we really focus on is helping people visually be able to understand how the trade's going to play out, and in what range it's going to be profitable in, and that. So but really what we're seeing is a lot, and our users, a lot of multi-leg trading to be able to take advantage of whatever their outlook is on a stock.
Oh man, I love that. I mean, my go-to trade is either buying a stock outright or a put spread, selling a put spread, or
Yep.
both.
Yep.
I mean,
Yep.
like I keep it so simple. And I mean, there was a point in time where, and iron condors have their place, but it's certainly when I was, it certainly was not when I was learning to trade because because I decided that iron condors were like the trade, right? It can go up, it can go down, it can stay where it's at, and it still makes money. This is the greatest trade ever, Rants. But then I didn't take into account like there's this thing called trends, right? And trends give no shits about your iron condors. They'll go straight through them.
Yep.
And so yeah, that's one of the ways that I paid my Wall Street tuition was learning about that. So that's cool. I like to hear that when I talk to people and they're like, oh yeah, I just buy like boatloads of YOLO calls. I'm like, okay, well, what time is it? What time are you going to blow up your account? You know,
Right. It's always swinging for the fences, and if as soon as you strike out one too many times, you get wiped out with that type of approach, right? It's a dangerous way to go. And what's I think even more dangerous about that is like what's happening right now, where we're at right this minute in the market. If you look at what's happened since March, we've seen a massive increase. There's been about a 30% increase year over year in options volume this year, and it's sustained from this. It started picking up even before COVID. Back in January, we saw it up about 20%. Then we saw March actions happen, and then from that, we've seen a lot of people coming in. The challenge is if you came in at that low point and you were just buying calls, you could look brilliant.
Yeah.
Right. But don't confuse brilliance with a bull market, because right now we're no longer in that exact same kind of run. Right. And so we're seeing a little bit of an adjustment, a shift. And actually, I'd love to share some stats with you, because I think there's some telltale sign coming up. But you look at this and you see people coming in and doing that type of, massive bull run. They're buying calls. They made all this money. They think they're brilliant at what they're doing. And then they walk right into an adjustment in the market and get their head handed to them. And that's a thing I think it's so important to understand this instrument. This instrument of options is so incredibly powerful. You can literally trade in about any market condition you want to, but you have to use the right tool, the right setups, the right option strategies for what the market's giving you. And you mentioned the put spreads. I love doing put spreads where you're doing those put spreads below support level on a stock, and taking a nice little premium on it, and being able to turn around a decent return in that. But you got to make sure you're watching, because again, if it goes against you, a put spread can you could be at a 5-to-1 or maybe even a higher risk reward ratio. And so if it goes against you and you don't act, you get your, again, it's an expensive piece. So you want to make sure to act on it and do what you need to do to get out of those that aren't working and can, ride those that are. So
that makes, yes, you're totally right. I was teaching somebody about put spreads the other day, and I'm like, this is a great strategy. It is proven mathematically to work, and you put it below support, as you were talking about. Like, I use a lot of back tested trend lines whenever I'm putting this on. It sounds like you and I have similar trading styles. And I was like, but know that I'm handing you a hot grenade here, right? If you don't take care of this, it will blow out your account, and faster than you even want it to. So yeah, I have learned to respect the risk of that. But there's this. I heard a couple of stories. One of them was this person who, I think he must have bought long calls at the March low, like you were talking about, and he was killing it. And he was killing it so well that he had made like $900,000 off of a handful of thousands of dollars. And so he started mortgaging his house, taking out second mortgages and things like that to leverage up. And the next thing he knows, like, the market stopped going up, and then he was just left with nothing. Like, his account went from nearly $1 million to zero in a matter of weeks. And he wanted to blame Robinhood for it. He was like, this is Robinhood's fault. They should have fixed this.
Well, yeah, right. I know. This is, I saw some support questions on the forum from Robinhood, and one of them was, if I buy a stock and I don't like it, can I return it?
Yeah.
Those kind of things. It just shows you. So, but again, Robinhood they've done a good job of casting this huge net, and they've had a lot of people come in, and they're advertising on the simplicity. But the reality is, their simplicity, I think, is not there's a difference between making the complex easy simple. That's what we focus on. There's another thing in providing a small amount of information and calling that simple. And I think that's a little bit of, if you know what you're doing and you want to do that, that's fine. Robinhood's, certainly, a great, one of the great ones out there you can work with, but be careful with what the technology is providing you, because I think it doesn't give you enough of a picture and end up with something like that. But you can't blame your broker because you made you made some bad moves because you were all starry-eyed about the results you were getting from March, right? And then you walk into what's happened in the last few weeks. And one of the things about buying options, and yes, it would have been a great move to do in a little bit, but the thing about buying a call option is that there's time premium and volatility premium in that. So what has to happen, and I know you know this too, it has to move basically more than the market, quote, thinks it's going to move based on the current option pricing in order for you to make money, because that time decay and that potential volatility decay is going to pull premium out of those. And when you do spreads, as you're basically buying and selling, so you reduce the impact of those, of time and volatility. But I've had so many people that have said, I bought the stock, I bought the option on it, I thought it was going to go up, it went up, and I still didn't make money. Right. And I know you've seen those happen as well. And so again, it's an incredible instrument to use. You can use it to hedge large portfolios. If you're small, you can, if you got a small account, you can use it to leverage up to be able to get, build your account up to to that 900,000. But you start to get up to a certain point, you got to start operating differently in how you're going to treat those options. And that's something I think a lot of people miss. And I think it's so important for people like you that are helping to get that message out there about what you can do with them and to be able to do it in an educated and safer way.
Right. Using spreads, I think, is by far the best way to trade. And that's just my opinion. Because, like, for example, when I was teaching this person how to trade, I was like, look, you can buy 2 shares of Microsoft and it'll cost you like $400. Or you can sell a put spread on Microsoft, like $5-6 wide, something like that, still risking about the same $400 in margin, but your return could be, I don't know, let's call it $100 on a $5 wide spread, right? So Microsoft would have to go up $50 in your 2 shares that you bought in order to get the same dollar return as it would by just selling one put spread. It just makes life so much easier. Higher returns, higher probability of profit. And overall, I think a much better strategy once you know how to do it, right? It's like if you were handing me the keys to a Formula One race car, and I was like, sweet, I can't wait to drive this thing, but I have literally no idea what all the buttons on the steering wheel do, all these buttons on all sides of me, and it's like, yes, you can drive it, but you probably need, I don't know, several hundred hours worth of education just to make sure you can like put it in gear and not, crash it immediately.
So, and that's I think that's a great analogy. And I think that, your options are throwing the keys to the sports car to somebody that hasn't really learned how to drive yet. That's a really, really dangerous thing. And the thing is, it's not really hard. It's different than just buying stock and hope it goes up. And so you just need to understand the instrument, and you mentioned Microsoft, which is trading at like, a little bit over $200. You take something like an Amazon, which, on the COVID front has been, has benefited from this, right? And, there are several stocks that I found, the work at home, play at home, entertain yourself at home type of thing, the stocks that would benefit from that. And certainly Amazon was one of those. And the thing is, though, it's a $3,000 stock. And a lot of times people can't even go into something like that. Right. So, one of the questions I hear quite often is, do you know any good stocks under $5? Well, no, there's a reason why they're under $5. Right?
That's what I was exactly thinking. There's a reason they're under $5.
Exactly. Why not trade something that's a solid company like the Apples of the world, or or the Amazons, or whatever that now Apple's since split, so it's a little bit more reasonable. But at a $3,000 stock, you can go into this with options, especially if you do a spread, at a really cost-effective approach. And you only have to see a relatively small movement in Amazon to really have it pay off in, literally in a potential double. If you're like in a bull call spread, a little bit out of the money, let it ride. You can make some really strong returns with it. But again, you got to know what you're doing, and if things start to move against you, be quicker to be able to adjust. But one of the other things I like about options is that what you started with doesn't mean that that's where you have to end up, right? If you started out
Okay.
with, let's say, a bull put spread for this month, and we see this correction happening, you could potentially roll that out, make an adjustment to it, and still be okay if it's moved against you a little bit right now. Still be okay in this because of how you can adjust it, and that's one of the great things I think about options. But you gotta be quick to move if things are not going the way you want. And you need to make sure, and this is one of the big ones, you have to make sure you understand your risk when you get into these. Somebody going out and selling naked puts into this run up, well, then you get this kind of an adjustment that we're seeing right now. That could be a real challenge.
It
Right?
could hurt real bad. Yeah.
It can
I don't
hurt real
do
bad.
anything naked at all
Yeah,
whatsoever.
never.
And honestly, because it's first off, you're taking 20% of the price of the stock in margin, or you could just buy the other leg and
have
done.
a finite risk, because that 20% in margin isn't your risk. That's only what the broker's making you put up. But it can go way past that, right? But if you buy that other put, you've now limited your cost, and you've put a floor in what your risk is in the trade. So absolutely a better way to go.
Plus, you can actually do like return on risk or return on investment calculations on that, right? What's your return on a naked put, right? It doesn't compute.
Return on cash is one thing, but that's not return on risk. And as we both know, you can lose more than the cash hold on that, right? And so it's a lot more challenging to do. And that's one of the things I think a lot of people don't understand is that they come into it and they're not educated enough on it, and then they do things like that and they take on the risk. I only had to put up 20% of the stock price to do it, and they're not really aware of the what the ultimate risk could be, right?
Right.
So
so let's talk. I was just going to say, I know you mentioned before the show about talking about some of the options details or activity or things that you're noticing out in the marketplace right now. What are you seeing out there?
Well, this is real interesting. So one of the things that we do with options data is prior to the triple witching Friday, which last Friday was one of those, right? So prior to the triple witching Friday, we start to look at the options volume, but we take out the triple witching Friday volume, right? Because that's people are closing out positions to frequently roll to others or move out, right? So I don't want to see what the triple witching is. I want to see what people were doing beyond that as they're coming into that triple witching Friday to see where they're putting it out further. And by the way, while we've seen a 30% increase in options volume this year, it's still over half of the volume is still driven by institutions. And institutions are the ones really working those triple witchings and rolling out and moving positions. And so we wanted to see that. So it was interesting here. We look back in March when the market was down and the VIX was really, really high, you started to see a lot more put activity at the bottom, right? Coming into the bottom, because if you have high implied volatility, which was off the charts in March, and you see excessive put activity, it generally kind of tends to bring in a bottom, right? Because people are like, okay, they're insuring this, it's not going to go lower than this. We had the high VIX. There, in some cases, there's, whether it's selling or buying, it's a little bit harder to tell. I mean, there's ways to get into that, but what we're looking at is just the overall what's happening here. So then you saw this high VIX and this heavier put volume tends to show a bottom, and it did. Then we come into March, which was really balanced on the call volume and put volume. June. The June was really pretty balanced, and it it didn't really change much of the trend. Things just kind of kept going as it was going, which is, again, a balanced is going to show you that it wasn't skewed one way or the other. So then we look at this last one, and then we see a couple things happening. Number one, when you see VIX relatively low, the volatility index relatively low, and you see more put buying, it's more of a prep for potential downside, right? The lower volatility, and you start to see that increase or skewing up of put activity tends to indicate uncertainty, and usually it's followed by climbing in the VIX, right? So, and what we're seeing right now is as people are, we're going into now October, which is always an can be interesting months, right? What we've seen, but then from that into an election, we have potentially another another I don't want to say another wave. I don't say second wave because I don't think we're out of the first yet, but more of a wave in this with COVID coming. We have an election that more and more looks like it's going to be contested one way or the other, right? And and that's never, how's the market going to react to that? I don't know. I haven't seen that type of a thing happen around an election in my lifetime, at least. But what we're seeing is preparation for a downward move. So I am a little bit cautious right now. I'd say I'm not saying I'm not in the market. I am in, but shorter leash, and I'm making sure I've got on the downside defined risk, and quite honestly, prepped for taking advantage of a downside, which is again one of the things about options that you can make money on those bear moves. So that's what we're seeing right now is preparation for more of a downturn. Now we've seen a little bit of an adjustment in the markets, last little bit here, but the level of activity we're seeing on it, I think there's a potentially deeper dive yet to come as we come into the election time and the end of the year here. So I'm a little bit concerned about what that's going to do for the broad market, and at the same time, as an options trader, just watching for how we're going to take advantage of the move when it happens. So
yeah, who was it? I've done successfully well trading bull and bear moves, but in the last couple of weeks, I was caught long with some gap downs that I was not planning on, and that it happens, right? But then right now I'm looking at these candles, and it's funny. You can look at any chart, right? And when they're bullish candles, they're little bitty tiny candles as they go up. Then when they're bearish candles, they're 6 times as big, right? All the way down. And so that's what I'm seeing right now, right? We had these big gap moves. We're seeing these big candles, and I'm like, you know what? This could be a repeat of March all over again, or it could just fizzle out. But right now, I'm in total cash since last week, and just hanging out, just waiting on opportunities to arrive. And as you and I both know, there's no point in forcing trades when you can just kind of work with them and let them show you the direction they're going to go.
Yeah, and so for me personally, I'm about 30% cash. I have a fairly large portfolio of positions still in the market, but what we've been doing is we've been, picking up some puts. One of the things that's actually kind of interesting is you talk about you could do a bear put spread on overlaid on a stock position. And the difference is that now instead of buying a put, which can be pretty expensive in times of uncertainty, right? As your floor, as your kind of insurance policy. And so what you do is you'll buy it out of the money, right? So you'll get a little bit cheaper put, but now you're taking on some risk there. Well, by doing a put spread, you're basically protecting closer to where the current action is, but not for catastrophic, right? Because it could go past your put spread, and now you're still in the stock, so you still have that downside move. But that's something that I've been doing a little bit here is some put spreads against my long positions to buffer against a potential correction, and we keep those fairly inexpensive by, instead of just buying the puts, doing the spread, to help cover that. So, it doesn't cover catastrophic market, but it covers very nicely a pullback in the market. So that's one of the things that I've been doing right now to protect from that a little bit. But yeah, I'm with you. And definitely positioning for taking advantage of whatever move is established, right? Whatever's going on. I think the hardest market to trade is the shifting sands, right? Where things are flip-flopping around, right? I can trade bull, bear, stagnant, vol, but it's when it's that shift that you have to watch, which we saw a couple weeks ago where, a little bit of a shift happening, but we haven't really established a specific direction or trend right now. So I'm with you. I've definitely got a bit more than usual in cash, but hanging here, looking for the opportunity. And what I am in, I'm doing more of a job of protecting. So.
Yeah, for sure. So you mentioned before the show, and I want to really talk about it, how journaling makes a huge difference to you.
Yes.
I'm a huge believer in that. In fact, one of the things I do is I have a spreadsheet, and I feel like you and I are kindred spirits. I list out literally every single trade I make, every stock, every put, whatever, the quantity I make, the price I got in, the price I got out, the price of the stock when I got in, the price of the stock when I got out. And then I keep track of the ROI on that particular trade, on that particular month. In fact, it's basically a pivot table, and it shows my stocks that I've traded versus the strategies I've traded. So I can tell you exactly, TLT long stock or something like that has been my best trade this year. I'm going to focus more on TLT long stock or something like that.
I'll tell you that, it's real unfortunate that the vast majority of people don't do that part of their due diligence in their trading, right? And Chris, the fact that you're doing that in a spreadsheet is, trying to get people to really follow up and always track is challenging. And you're at an active day, even for you, it's like you have to kind of go catch up with it, right? So
yeah.
So one of the things we did in Market Gear was we actually auto journal, and we auto. There's quite a bit around the journaling part that we've made automatic, but one of them is, for example, we identify what the strategy was. So we identify about 70 different option strategies, plus you can name it whatever you want and all that, and we tag it with that. But then, what I tell people to do is there's 4 things that you should track in your in journaling, and we do it just by simply tagging, because then you get tag reports and you can know what tags are performing what way, right? So one of them is, what's the strategy you're doing, right? Which we auto identify, but whether it's long stock or whether it's that bull put or some other options position, to know what the strategy is. Number 2 is know why, how you found the stock, right? So how you found it, and number 3 is why you're trading it, right? Those are 2. You found it from watching Mad Money on CNBC, and then, okay, well, what was it about that, what are you trying to take advantage of in this thing? So why you're trading it. And then the 4th one, and this one I think is also really important for people to do and is missed a lot, is what is your exit strategy, right? And then when you get out, did you follow that strategy, right? So you decide up front what your exit strategy is, and then did you follow your discipline, right? And with those 4 things, how you found it, why you're trading it, and what they were, and then what your exit strategy is, and you track that over some time, you'll find that you'll distill down really quick what's working for you and what's not. And if all you do is just do more of what is, like you were just talking about, right? Do more of what is working and less of what's not, you're already going to improve. But then you can take what you're doing. In fact, one of the things that, we have virtual account capability in here. One of the things that we suggest people do that are still learning and mastering strategies is trade your real trade and then throw another one on a different way, maybe more aggressive or different approach or whatever in your virtual, and compete with yourself, right? The virtual is no risk, right? Use that as a learning opportunity. And then in our journal, you can literally see side by side how those are working out. And so if something's not working real well for you, stop doing it. Maybe then move that to a virtual, still try to work and get better at it, and then bring that back into your primary trading thing. But being able to look at, okay, because I'll tell you that bull puts have worked out super well for me as well. Doing the out of the money credit spreads has worked out incredibly well. And you can see your rate there, how you're doing on it, the number of trades, average time in trade, and all that, and know how it's playing out. And then we also, you mentioned the spreadsheet thing, which is awesome. But one of the things about us is we have a few different visual things on how you're trading against the S&P 500. Things like that. What your length of time in trade is, because what we find is that a lot of times, if you do it by number of days, and we separate out options and stock for this, and you look at number of days, and you'll see a fall off, right? The profitability, and then what people do is think trades don't go well, and they stay in them too long, and then they, that you get past that sweet spot in your trading time, you start to see most of those are losses. Well, if you see that visually, if you see right there that, look, if I'm holding them longer than I'm supposed to, and it usually doesn't work out for me, it just reinforces the importance of if the trend breaks, if your rule to get out was, if the trend breaks, get out of this, or if it breaks that support level on that vertical, credit vertical, get out. And you start doing that, and you start to see how that improves what your results are. So journaling is, out of all the things I've seen, that we brought this feature in, and we brought it in a couple of years ago, actually like 3 years ago now. The response we've had for it's been huge, because that reason, it makes it very, very apparent what's working for you and what's not. And you look at that, and you get that analysis, and you just operate from just, wow, I didn't know that. I mean, I'll tell you a personal experience with it. I didn't know my straddles weren't working. right? Because straddles coming into earnings, right? And you
Mhm.
buy it before the implied goes up too much, and buy more time than you're going to be in, so you don't have as much time decay, right? All these rules. Well, what wasn't working for me, and but I had these great wins, right? But you'd have these little losses, but those little losses were beating my strong wins. And so I saw that, and I changed my approach. It had to do with my time, how long before I was getting in, and some things around that. Also, making sure my implied was lower. I was getting in a little bit too rich sometimes, right? So, and again, because you can go back and look at this trade by trade, you can actually take a trade you did and throw it into a back test and see day by day how it performed. And so you can get a really good post-trade analysis of it and be able to come up with what would have been a better approach and how should you have done this. And so journaling is just an incredibly important tool. And any institutional trader that I've ever talked with, they don't necessarily call it journaling because they have other accounting things that they're doing with that, but it's still the same thing. They have an accounting of what they're doing, and adjust that accordingly. Floor trading firms I've worked with, same thing with that. They're tracking what people were, how things are working, and they're adjusting how they're approaching things based on what their results are, right? So, it's the way it works. If you're running a business, you're going to find out, running a restaurant, what dishes are selling, which ones aren't. Get rid of the ones that aren't working, right? And the same thing here in your trading, right? And without the data, you have no way of doing that. So I think it's an incredibly important tool. And whether you do it from a spreadsheet, whether you do it from a platform that does it for you as part of the thing, it doesn't matter. Other than the problem with the spreadsheet is I'm sure you have to be pretty disciplined to stay up with that.
You're right.
Right. But if you do it, the return on that investment of time can be invaluable in the insight that you get in your own trading and your own approach.
Yeah, totally agree.
I've written a short guide on how you can use the triple stock profit system. It's the secret weapon every investor needs right now to change your financial future. And you can get it for free by visiting triplestockprofits.com or in the links below. Also, if you want to join a community of traders just like you can get free access to the elite membership that has even more resources to help you trade faster and trade smarter.
Well, Rance, I got to let you go. I feel like we could do this for another 2 hours or so. So I want to have you back on because I think you and I are just scraping the tip of the iceberg here. So make sure you guys head on over.
I've really enjoyed our chat here and a little bit in the pre-chat. I really would like to connect with you. I think that we have a nice alignment of some of our approach for sure.
I agree. Yeah, for sure. So really, thank you for your time. And I'm going to tell everybody to head on over to marketgear.com, where Rance is the founder and creator, and you can learn more about his product and hopefully integrate that into your trading plan going forward. So Rance, I really appreciate your time. Sorry, I got to run. I got another podcast to do. It's one of those days.
Thanks very much.
It's a wonderful problem to have. So,
all right, we'll talk to you again soon.
Yeah, thank you so much, Rance. And thank you guys for tuning in to today's How to Trade Stocks Options pod. Make sure you like, subscribe, and enable notifications. That way you never miss the tools, tips, and tricks we upload every single week to help you trade faster and trade smarter. And I'll see you on the next episode.